Right now, the world's economy feels like a roller coaster. But what if I told you that these are often the very best times to build serious wealth?
U.S. strikes Iranian nuclear sites. Middle East tensions escalate.
Today's agenda. In this video, we'll break down why current world events might not be as spooky as you think, what history tells us about markets recovering from big shocks, why investing during tough times can actually make you rich, the big economic picture for 2025, good news and challenges, and our simple strategy, how to invest right now to protect and grow your money.
Everyone else was scared. I saw an opportunity.
Why invest during uncertainty? Examples and historical insights. This might sound crazy, but some of the biggest fortunes have been built by investors who bought when everyone else was scared. Why? Because when the market crashes or goes through a correction, meaning prices fall, you get to buy great companies at a much lower price. It's like getting your favorite shoes on a massive sale. Think about it. After big financial problems like the 2008 crisis, companies like Apple or Microsoft were much cheaper than they are today. The brave investors who bought solid companies when their prices were low ended up seeing huge growth later on. This is because buying during a dip means you're getting things on sale. When the market eventually recovers, and history shows it always does, your investments can soar. The world has certainly seen many disturbances since 2020, one challenge after another. But interestingly, this current conflict isn't spooking investors too much compared to some past crises. People are perhaps a bit more used to uncertainty now, which means there might not be the same widespread panic selling we've seen before. What historical data tells us? Market resilience and recovery. So, is it the right time to start investing, or should you wait? What does historical data tell us? Think of it like this. Imagine you're playing a game. Sometimes a big obstacle pops up and you might stumble. But usually, if you keep going, you recover and get back on track. Markets are a bit like that too. Looking at past big events, like the attack on Pearl Harbor in 1941, or Iraq's invasion of Kuwait in 1990, markets did dip for a bit. People got nervous. But the data shows something amazing. They always came back stronger. For example, after Pearl Harbor, the market recovered in about 300 days. After Iraq invaded Kuwait, it was even faster, around 189 days. This tells us that while things can get bumpy in the short term, markets are super resilient over the long run. So, based on data, waiting simply means you might miss the recovery. Current market dynamics and liquidity. Now, about what's happening right now. While there are certainly challenges, there's also massive liquidity already being released into the market. This means there's a big pool of money waiting for good places to go, which can support stock prices. So you should prepare for volatility, meaning expect things to go up and down. But you should also be a net investor in equities, which just means you should still be putting money into stocks overall. Don't pull out completely. The 2025 Global Economic Outlook, Headwinds and Tailwinds, Regional Growth. Let's zoom out to the bigger picture, the global economy. Our report shows a mixed bag. On one hand, global growth is slowing down to about 2.3% to 2.4% in 2025. Trade tensions and inflation are also playing their part, making things a bit tougher. But here's the good news. A global recession, when the economy actually shrinks, is not expected for 2025. That's a huge positive. Plus, some parts of the world are still growing strong. Places like South Asia are projected to grow by almost 6%, and even the Middle East and Africa are looking at decent growth. This means if you spread your investments around the world, you can tap into these growing areas. And guess what? Central banks, like the European Central Bank, have already started to lower interest rates. The US Federal Reserve and the Bank of England might do the same later this year. Lower rates can make it cheaper for companies to borrow money and grow, which is usually good for stock prices. Zalwora investment strategy, 70–80% equity, 20–30% cash explained. So, putting it all together, what's the smart move? Our Zalwora strategy is about being cautious but opportunistic. It's about being smart when the market is doing well, but also ready to act when it dips. Here's the simple breakdown. We suggest keeping about 70% to 80% of your investment money in equities, that's stocks. This means you're actively participating in the market's growth, even if it's a bit overvalued right now. This is following 70–80% investment when markets are fair to slight overvalued, keeping your money working for you. And the other 20% to 30%, keep that in cash. This is what we call your dry powder. Imagine it like having extra ammo in a game. When the market has a correction, meaning stocks suddenly drop a bit, that's when you deploy your cash. You use that dry powder to buy more stocks at a lower price, in case of a correction, turning a temporary dip into a long-term opportunity. Your strategic action plan. So, your action plan is simple. First, stay informed. Keep an eye on what's happening in the world and with central banks. Second, remain diversified. Don't put all your eggs in one basket. Invest in different types of companies, industries, and countries. Third, maintain a long-term view. Remember those historical charts? Don't panic if things get shaky in the short term. Fourth, be prepared to act. Have that cash ready. When good companies go on sale because the market is nervous, that's your moment to buy. Conclusion and call to action. By understanding the data, being smart about your risks, and staying focused on the long game, you can turn uncertainty into an opportunity for your financial future. Remember, every challenge can be a chance to learn and grow. That's it for today's Zalwora Insight. Don't forget to like, subscribe, and share this video with your friends and family. See you next time.